Well, let's move on here. We're out of time. What's our last company here? Talking about restaurant brands because we did talk about the beef side. So let's see what that's going for the restaurants here. Restaurant brands, their symbol is, and it's Restaurant Brands International. It's QSR in the restaurant industry. Not much on the float side, short side, 3.6%. PE ratio, 26.2. That is below the industry at 33. Price to sales, 3.3 versus 2.4. Price to book value does look good, 6.6 versus 16.1. And price to cash flow, 18.4, just slightly above 17 for the industry. And they do not have a PEG ratio, unfortunately. Now, we do see over the last year, the earnings for restaurant brands is down 11.3%, but yet the industry was up 5.8. Sales were up 11.8% for restaurant brands, but down 3.4% for the industry. Analysts don't seem to like this going forward. The 5-year earnings per share growth estimate, a negative 0.3%, but yet the industry is a positive 9.7%. You do get a nice dividend, 3.8%. They use about 86% of their earnings to pay that out. That's a little bit high for me, but still a decent dividend. Look at the balance sheet, current ratio 1.1, same as the industry. That's good. But debt to equity, not so good, 4.7. That's well above where you feel comfortable versus 1 for the industry. So I will check if I can here the balance sheet to see if they have a lot of debt or just low equity. A lot of intangible assets, 67% versus 15.9. Net profit margin is 10 versus 7.7. Return to equity, very good. Tell me maybe a low equity, 27.3. Free cash flow, 1.4 billion. That's below the industry at 3.2 billion. A lot of stuff there. Not too excited about it. What do you got going forward?
Yeah, and I'm sure it's kind of like McDonald's and the other fast food restaurants where it's a franchise model is how they're going to be operating, which kind of distorts the balance sheet a little bit. What we call asset-light businesses. Give you an idea too. You might hear the restaurant brand's name. What is it? You're going to recognize these companies. Burger King. Mm-hmm. Another big one is Popeyes. The other ones that they have is Tim Hortons. Not as familiar with that. And Firehouse Subs. I used to see that when I was in Arizona. I don't really know of any Firehouse Subs around here, but the big ones that obviously I recognize here in San Diego is going to be Popeyes and Burger King. But looking at the current price for restaurant brands, again, their ticker symbol QSR, $68.82. 52-week range here, not bad. The low, $58.71, and the high, $73.70. Year-to-date, the stock is about flat. Over the last 1 year, it's up about 9%. Last 5 years, haven't made much money, though, about 13%. 10-year return, not bad, up 100%, not including the dividend yield there as well. Going forward, though, for restaurant brands, we go out to December 2027. Estimated earnings per share, $4.38, gives us a target sell price here of $72.71. So it would be in our hold category at this time based off the valuation.
And they do have a lot of debt. I did look at the balance sheet here. They do have about $16 billion in debt on the balance sheet, which is pretty high. And I think I saw also two intangible assets were pretty high as well.
The other thing that I bring up with the debt, though, is that includes leases. I don't always view that as bad debt, right? If you have like a 10-year lease, I almost view that more as an expense than debt because it's just kind of part of your operating expenditures. But that is one thing I'd want to understand as well.
And a lot of goodwill and intangible assets. Goodwill's $6.3 billion and intangible assets $11.3 billion. So very weak balance sheet. And again, I hear what you're saying about the leases, everything else, but still there's a lot of worrisome things on here. And good companies. I mean, I think you said Burger King. And,
I was talking to somebody this last week, and some of these fast food restaurants, I mean, they kind of scare me in terms of obviously the health perspective. And the reason people go to them is for value. And I was talking about McDonald's in particular. I'm sure these are similar, but McDonald's has like a $5 deal now where you get like a cheeseburger and 4 nuggets and I think maybe a soft drink as well. And you talk about the price of beef. How in the world are they profitable producing a cheeseburger and nuggets for $5? There's no way that's good for you.
Well, you know what it is you go. I went to Carl's Jr. the other day because I forgot my lunch. Yeah. So I went there and they go, "You want to supersize it?" Yeah, go ahead. So you go in there for that meal deal of $5. You want to supersize it? You get the big Coke. You get the go ahead and do that. So they probably make a bigger profit off of doing that. So it's getting people there to the store, kind of like a lost leader, to get you in there to buy more.
Yeah, I still just can't imagine that it's obviously.
And have you seen the pictures of the drive-through, the burgers? Gosh, they look so good.
Yeah, no, I actually haven't eaten fast food in quite a while.
Really?
Outside of In-N-Out. That's my problem, too. In-N-Out is so good. and I don't feel as bad after eating it, and the prices are really fair in my mind. So it's like, gosh, I don't know. I feel like it's hard for me to go to any other fast food restaurant.
I would go to Jack in the Box. Jack in the Box is a favorite. I would even invest in Jack in the Box if it was on sale, but it's not. 'Cause
Jack in
it's
the Box,
pure.
I thought was on sale. It's just,
Was it?
yeah, their balance sheet is a big question mark.
That's
though.
what it was. Yeah, yeah. But they're a pure place. All right, there's a closing bell. Thank you for listening to the Smart Investing Show.